Hey friends, welcome to the ultimate Vanguard ETF investing guide in Australia. In this video, I'm going to show you 12 of the most popular Vanguard ETFs in Australia. I'll teach you all the important terms and what you need to look out for when trying to find the right ETF to invest in. So this includes the management fees, the yearly performance, dividends, and the top holdings for each ETF. Now there are many ETFs out there, but I've kept this video purely just Vanguard ETFs because it's very popular with Aussie investors. I would encourage you to watch this entire video, or at the very least the first ETF, to understand all the terms and things you need to look out for. Let's get straight into it. The first ETF on our list is VAS, which is the Vanguard Australian Shares Index ETF. This is arguably Australia's most popular ETF. This ETF tracks the return of the top 300 Australian companies such as BHP, Commonwealth and CSL. So if you are investing into this ETF, you are essentially investing into the entire Australian stock market. The management fee is 0.07%. This means if you invested $1,000 into VAS, you would be charged 70 cents per year. So it's relatively low in the grand scheme of things. And don't worry, you don't have to remember to pay this fee. It will be automatically deducted from the share price. So there is no out-of-pocket expense, and this goes for all the ETFs on the list. The inception date was May 2009, so it's been around for over 15 years. Income distribution means how often are dividends paid, and in this case it's quarterly. So 4 times a year. This ETF also allows Distribution Reinvestment Plan, or DRP for short. This basically means you can set the dividends to automatically reinvest themselves whenever you are paid. For example, you are paid $100 of dividend and each share is worth about $40 each. If you have set up DRP, it will automatically buy an extra 2 shares for you. And the remaining $20 will sit in your account and will be added to your next dividend payment. Let's now look at the performance return. So there are 5 different headings here. ETF is the gross return of the ETF, not including management fees. BMK is the performance of the benchmark, which is what the ETF is trying to replicate. In this case, VAS is trying to replicate the S&P and ASX 300 index. As you can see, the return is quite similar, give or take some operational fees here and there. ETF total is the return after management fees have been deducted and assuming you reinvest your dividends. So I prefer to look at this particular column because I think it's the most accurate after taking into account all the fees. Distribution return is the total dividends return. The growth return is the total share price increase or decrease. Generally, you make money with stocks in 2 ways. 1, from the share price appreciation. So say for example, you own 10 shares of VAS at $100 each worth $1,000. If the share price increases to $110 each, then your total shares value will increase to $1,100, giving you $100 profit. And 2, you can make money with dividends. This is when a company makes a profit for the year, so they choose to share some of the profit to their shareholders in the form of dividends. Now please note, a company is not required by law to pay dividends. Even if they make a profit, it's at the company's discretion whether they want to pay dividends. However, blue chip companies have a reputation of paying dividends, so if they continue to be profitable, it is probably in their best interest to keep paying dividends. By law, an ETF must pass down any dividends they receive from the companies that they hold. For example, if Commonwealth Bank decides to pay a dividend, since it's one of VAS's holdings, VAS must pass on that dividend to the shareholder. However, Commonwealth Bank can decide not to pay a dividend, then in which case VAS will also not pay dividends for the Commonwealth portion. So back to the performance table. The total of the distribution plus growth equals the ETF total. So we can look at the 1 to 10 years average annual return. Please note, this is the average annual return and not the total return. So in a 10-year span, some years may have returned 20% and maybe some years returned negative 10%. But on average, it returned about 7.8%. And what I immediately noticed is that the ETF performed better on average in the last few years compared to the last 10 years. But if you look at the since inception return, which is the 15-year annual return in this case, it is still relatively high. This goes to show ETFs generally perform well over the long term. Another interesting observation is that over the last 10 years, the dividend return is higher than the share price appreciation. This isn't too surprising given Australian companies have a reputation of paying high dividends. So it's important to note that the ETF total assumes that you are reinvesting your dividends. So the DRP feature we previously talked about does come in handy in this case. Let's scroll down to the next page. There are a few financial stats here if you're interested. I won't go through each one or this video will go on forever, but if you're curious to know what they are, you can quickly Google them. So you have the top 10 holdings listed here, and it breaks down each sector by percentage for you. And unsurprisingly, over 50% is either financials or materials, which makes sense since Australia is famous for our big banks and mining companies. Now if you want to find more information on a particular ETF on this list, I'll leave a link in the description to this page which contains a list of all the available Vanguard ETFs that are listed on the ASX. So in this case, since we're looking at VAS, we can search for it here and click the link. It will bring you onto this page where you can find all the important details like the overview, portfolio data, performance, prices, and dividend history, among other things. As you can see, there is a lot of info here, so if you wanted a summarized version of it, you can click Document and Fact Sheet, and it will bring up a nice 2-page summary of all the important things you need to know about your chosen ETF. And this information and fact sheet is available for all the ETFs mentioned in this video. The next ETF is VTS, which is the Vanguard US Total Market Shares Index ETF. This ETF tracks the performance of the entire US stock market. Please note, the entire US stock market makes up about 60% of the entire global stock market. Investing into VTS will give you exposure to some of the world's largest US companies such as Microsoft, Apple, and Google. The management fee is 0.03%, which means you will be charged 30 cents for every $1,000 you invest in. They also pay a quarterly dividend. However, please note that VTS is US domiciled, which basically means it's registered in the US for tax purposes. Therefore, you cannot set up a DRP, and the tax is a bit more complicated to work out. However, you could easily use something like ShareSite to work out your tax for you during tax time, so in my opinion, it's not a deal breaker. Let's look at the performance. If you invested 10K into VTS 5 years ago, you would have about 21K today. So that's a bit more than a double up. In fact, VTS has returned around 15% per year on average in the last 10 years, which is an extremely good return. But please keep in mind, we have been going through the longest bull cycle in the last decade, and it's no guarantee to continue, especially at 15% per year. Over the last 100 years, the US stock market has returned around 10% per year. So if you're looking for a pure US ETF to invest in from the ASX, then consider doing more research on VTS. The next ETF on the list is VEU, which is the Vanguard All World Excluding US Shares Index ETF. Oof, tongue twister. As the name suggests, this ETF provides exposure to many of the world's largest companies outside the US. Although the US does make up around 60% of the global stock market, there are still many great companies outside the US, such as the Taiwan Semiconductor Company, Nestle, and Samsung. There is quite an even spread of companies from developed and emerging markets such as Japan, the UK, France, China, Canada, and even Australia. The management fee is 0.08%, which means you'll pay 80 cents for every $1,000 invested. However, like VTS, this ETF is domiciled in the US, so that means no automatic dividend reinvestment plan. If you invested 10K into this ETF 5 years ago, you would have around 14.5K today. So that's around 7.6% annual return in the last 5 years. Not as great as VTS, but who's to say the US will continue dominating forever? So this ETF is for investors who want exposure to companies outside the US. The next ETF on the list is VGS, which is the Vanguard MSCI Index International Shares ETF. This is another popular ETF, especially to those in the Australian FIRE community. This ETF provides exposure to the world's largest companies outside of Australia. As you can see from the top holdings such as Apple, Nvidia, and Amazon, it's very US heavy. That is because the US makes up over 72% of this ETF. The next largest is Japan at around 6%. This makes sense since we already know the US market makes up the majority of the world's stock market. The Australian financial independence community likes to pair VGS with VAS, which basically gives you exposure to the entire global market, or at least all the largest companies listed in major developed countries like the US, Australia, Japan, the UK, and all the other countries listed here. The management fee is 0.18%, which is a bit higher than the previous ETFs. So that means you are paying $1.80 for every $1,000 invested. This is pretty cheap in my opinion for what you get. They pay a quarterly dividend, and this ETF is domiciled in Australia, which means you can set up DRP. Let's check out the performance. If you invested 10K in VGS 5 years ago, you would have around 19K today. So that is a 5-year annual average return of about 14%. So the return is similar to VTS, which makes sense since VGS is made up of 72% US stocks. This just means the other countries in the ETF did not perform as well as the US, hence bringing down the total return slightly compared to VTS. But again, please remember, just because the US has done well in the last 10 years does not mean it's guaranteed to do well in the future. That is why some people choose to diversify into an ETF like VGS, which provides a huge exposure to the US, but also contains other big companies from other developed countries. The next ETF on the list is VDHG, which is the Vanguard Diversified High Growth Index ETF. This is another popular choice in the Australian finance community, as it's an all-in-one ETF that basically tracks everything. VDHG is an ETF that tracks other ETFs. As you can see in the breakdown, it's made up of around 36% Aussie shares, 50% international shares, 5% emerging markets from countries like China, India, and Brazil, and the remaining 10% is made up of ETFs that track bonds and cash. So it's a very well diversified ETF that has a bit of everything. If you want a one-stop shop ETF that tracks a bit of everything in the global market, then check out VDHG. The management fee is 0.27%, which is a bit more expensive than some of the other ETFs on this list. However, you are getting a ton of exposure to many different markets. That works out to be $2.70 for every $1,000 invested. This ETF is domiciled in Australia, so you can set up DRP and you will receive dividends 4 times a year. Let's check out the performance. If you invested 10K 5 years ago, you would have around 15.6K today. So that is a 5-year average annual return of about 9.3%. Not bad at all for an extremely diversified ETF. You may have noticed it's not as high as VTS or VGS, but that is simply because the US market has outperformed in the last 5 years compared to other markets. Since VDHG is extremely diversified in other markets that did not perform as well, it means the overall return is not as high. However, if the US market underperforms, then it will not be as affected as other US heavy ETFs. So it's kind of a double-edged sword in terms of performance. The highest highs won't be super high, but then the lowest lows won't be super low. It will return the average of how the entire world performs. Now, there is a constant debate in the Australian finance community, especially in the FIRE community, about whether you should pick VAS plus VGS or just VDHG on its own. Now, there is no wrong answer. It really depends on your risk tolerance and strategy. It may be easier to rebalance VAS plus VGS when one ETF gets too high in your overall portfolio. Whereas with VDHG, you are stuck with the percentage allocation that they have picked for you. But then having only one ETF means less brokerage fees. You can nitpick all you want, but at the end of the day, you are investing into very similar things. It's basically the same thing, except VDHG is a bit more diversified with some emerging markets and bonds exposure. If you're a bit older or more conservative, then VDHG could be a better choice. However, please note this is not a buy recommendation. In fact, none of these ETFs that I talk about today are buy recommendations. I am not a financial advisor and this is not financial advice. All the examples I use in this video are for educational purposes only. Please do your own research and go see a professional if you would like financial advice. With that out of the way, let's move on. The next ETF on the list is VAP, which is the Vanguard Australian Property Securities Index ETF. This ETF allows you to invest in property securities listed on the ASX. It tracks the return of the ASX 300 A-REIT index. ARET stands for Australian Real Estate Investment Trusts. So basically, it's an ETF that allows you to invest into Australia's real estate market without actually buying the physical property. It contains some of Australia's biggest real estate groups, including the Goodman Group, Scentre Group, and Stockland. These companies own some of Australia's biggest retail, office, and industrial properties. So you can Google some of these companies to see what they own. For example, Goodman Group owns many warehouses, large facilities, and offices not just in Australia, but all over the world. The management fee is 0.23%, so you're paying $2.30 for every $1,000 invested. They pay a quarterly dividend and are domiciled in Australia, which means you can set up DRP. Now their performance is quite interesting. If you invested 10K 5 years ago, you would have around 13.2K today. So that's an average annual return of about 5.2%. Now the reason this is low is that you'll notice 5 years ago was 2019. And in 2020, we had the pandemic, which shut down the entire world. And a lot of people were laid off or working from home. So many offices and warehouses were closed, which affected the rental income for many of these companies. However, it has since recovered. If you look at the 10-year return, it's much more promising at an average return of 9.3% per year. So if you're interested in investing in Australian real estate, but don't have enough money for the physical property, you could look at an ETF like this or other ETFs or REITs. I would encourage you to do more research to find one that suits your strategy. The next ETF is VHY, which is the Vanguard Australian Shares High Yield ETF. This ETF provides exposure to companies on the ASX that pay a higher dividend compared to other companies. Basically, it contains over 70 of Australia's highest paying dividend companies, including NAB, Wesfarmers, and Woodside. A lot of these banking, mining, energy, and consumer discretionary companies are highly profitable, so they choose to pass on some of their profits in the form of dividends to make their shares more valuable. Australian blue chip companies are famous for paying a high dividend to attract new investors. However, please note that dividends are not guaranteed. There are no legal obligations for companies to pay dividends. Most profitable companies choose to pay dividends to attract new investors. But if the company did not have a good year, then they can choose to reduce or not pay dividends completely. I just wanted to put that out there because there are some misconceptions that dividends are guaranteed. VHY has a management fee of 0.25%, so you're paying $2.50 for every $1,000 invested. Like most Vanguard ETFs, they pay dividends quarterly, and you can set up DRP since they are Australian domiciled. If you invested 10K 5 years ago and reinvested your dividends, you would have around 16K today. That is a 5-year average annual return of about 10%. As you can see over the long term, more than 50% of this came from dividends rather than share price increase. This does make sense since this is a dividend focused ETF. And again, I want to remind you that these returns are assuming you invest all your dividends. Now I get a lot of questions about VHY versus VAS. It's interesting to note that VHY has performed better over 5 years, but VAS has performed better over 10 years. This could be due to the nature of the two ETFs. VAS contains more growth companies that have room to grow, which means in a stable environment, there are more potential for higher returns due to these companies becoming more profitable. In contrast, VHY only selects the blue chip companies that are already profitable and have less room to grow as a company. This means in a more unpredictable environment, investors may choose to invest in companies that are already established. VHY is more appropriate for those looking to be paid consistent dividends, and VAS is more appropriate for those who expect a bit of growth. However, since the big companies make up a large percentage of the ASX, basically all the companies in VHY is already included in VAS. It's just a bit more diluted with some smaller growth companies. So I would encourage you to do more research and select the one that suits your investment goals. The next ETF on the list is VSO, which is the Vanguard Australian Small Caps Index ETF. Now a lot of Australian ETFs are overweighted with big blue chip companies. This means the smaller companies will get drowned out in weighting. So this ETF gives you a chance to invest in over 180 of Australia's smaller companies. It contains companies like NextDC, Altium, and JB Hi-Fi. Since these are smaller cap stocks, they have the potential to provide greater returns. However, this also means it contains more risk with an increased likelihood some of these companies go out of business. Investing in an ETF does help negate that risk a bit. The management fee is 0.3%, which means you'll pay $3 for every $1,000 invested. And unlike some of the other ETFs, you'll be paid dividends twice a year instead of quarterly. Which makes sense since smaller companies pay dividends less often. And since the ETF is Australian domiciled, you can set up DRP. Let's look at the performance. If you invested 10k 5 years ago, you would have 14.5k today. So this ETF is for someone considering a more risky ETF that could potentially have a higher return. But as always, please do your own research. The next ETF on the list is VGE, which is the Vanguard Emerging Markets Shares ETF. This ETF provides exposure to companies listed on emerging markets. So countries like China, India, Brazil, South Africa, and Mexico. They are considered to be emerging markets, which means there is more potential for long-term growth, but at the same time, a bit more risk. Some of these companies include Taiwan Semiconductor Manufacturing Company, Tencent, and Reliance Industries. I bet you haven't heard of some of these companies. But that's the whole point. They are from an emerging market. And as you can see, the market allocation is quite Asia heavy. The top 3 countries are from Asia and make up 68% of the ETF. This does make sense since a lot of these emerging companies are from Asia. The management fee is 0.48%, which works out to be $4.80 for every $1,000 you invest. They pay a quarterly dividend and you can set up DRP since it's Australian domiciled. So if you invested 10k 5 years ago, you would have around 12k today. That is a 5-year average annual return of around 3.2%. Which to be honest is hardly impressive. However, please understand these are emerging markets, so they are less established than developed markets like the US, Australia, and the UK. So there could be higher highs but lower lows. If you look at the 10-year average return, it's a bit better at around 5.5%. This suggests that the ETF was doing much better before the pandemic. As I mentioned before, during economic downturns, investors usually flock to safer, more established stocks. This could explain the poor performance of VGE. Some investors like to add a small portion of emerging market ETFs into their portfolio so they can capture some of the upside if they do outperform. Like every ETF on this list, I would recommend you do more research if you're interested in emerging markets. The next ETF on the list is VAE, which is the Vanguard Asia excluding Japan Shares Index ETF. This ETF provides exposure to companies listed in Asia excluding Japan, Australia, and New Zealand. It's basically another emerging markets ETF which only contains Asian companies. As I mentioned previously, Asia already makes up a large percentage of all emerging markets. So VAE is made up of companies from China, India, Taiwan, Korea, and other Asian countries. Some of the top listed companies are Samsung, Tencent, and Alibaba. The management fee is 0.4%, which works out to be $4 for every $1,000 you invest. VAE pays dividends 4 times a year and are Australian domiciled, so you can set up DRP. If you invested 10k 5 years ago, you would have around 12k today. So that's a 5-year average annual return of about 3.8%, which is a bit higher than VGE. This suggests that Asian companies outperformed the rest of the emerging markets in the last 5 years. However, like VGE, this ETF may have a higher return potential but also comes with a bit more risk due to the nature of emerging markets. The next ETF on the list is VETH, which is the Vanguard Ethically Conscious Australian Shares ETF. This is an ethical ETF that provides exposure to companies listed on the Australian stock market that are not involved in fossil fuels, nuclear power, alcohol, and other requirements that are carefully screened. If you open the fact sheet and scroll down, you can get a better idea of their screening process and why some big companies have been excluded from the ETF. Some of their top holdings include Commonwealth Bank, Fortescue Metals, and Telstra. If you're interested, you can download their full holdings on their website. The management fee is 0.16%, which means you'll pay $1.60 for every $1,000 invested. You'll receive dividends quarterly and you can set up DRP since it's Australian domiciled. Please note this is still a new ETF that was formed in 2020, so you can only see the 3 years performance. If you invested 10k 3 years ago, you would have around 12.8k today. So that's a 3-year annual average return of 8.7%. Ethical investing has become more popular in the last few years to the new generation of investors who care about the ethical implications of the companies they are investing in. So if you're interested in ethical investing, you could look at this one, but please remember to do your own research. The next ETF on the list is VESB, which is the Vanguard Ethical Conscious International Shares Index ETF. This is another ethical ETF that provides exposure to the top ethical companies in the world excluding Australia. According to their website, this ETF is carefully screened to exclude companies with involvement in fossil fuels, nuclear power, alcohol, tobacco, cannabis, gambling, adult entertainment, or weapons. Some of their top companies include Microsoft, Tesla, and JP Morgan Chase. Like most global ETFs, it's dominated by US companies that make up around 73% of the entire ETF. Japan, UK, Switzerland, and Canada makes up the rest of the top 5. The management fee is 0.18%, which means you'll pay $1.80 for every $1,000 invested. You'll receive dividends 4 times a year, and you can set up DRP since it's Australian domiciled. Now let's look at the performance. If you invested 10K 5 years ago, you would have 19.5K today. That's almost a double up. This means the average annual return is around 14.3% for the last 5 years. This is a really good return, but please remember, it's not guaranteed to continue in the future. And this goes for all the ETFs on the list. By the way, if you're enjoying this video, comment the word moon down below so I know who you are. And if you're new around here, what are you waiting for, mate? Subscribe to the channel and join this amazing community. Also, be sure to sign up to my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, my current thoughts on the economy, and any cool things that are happening in my life. And if you want to learn how to invest in ETFs, then check out this video on screen where I show you how to buy ETFs using an Australian online broker. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.